It takes us to our talk of the tape, whether stocks are really back in an uptrend or if it's simply too soon to sound the all clear, even as those early month losses continue to evaporate. Let's ask Dan Greenhaus, Solus Alternative Asset Management's chief strategist, with me here at Post 9. It's nice to see you again.
Thank you, sir.
I mean, what a difference a couple of weeks make,
Sure.
right? In the middle of the month, you're like, all right, how deep is this correction going to be? At the low, we're down, the S&P was 5.5%. Here we are now. We're only down 1.5%. What's happened?
Yeah, I mean, you teased at the outset there that rates is a big part of this. I mean, within the context that rates have gone up and stocks have gone up alongside it, in the last couple of days, the pullback in longer-term rates from, call it 4.25 down closer to 4 is probably the main input right now. And you see the best performing sectors over that time is both tech and comm services. It's Tesla, it's the semiconductors more specifically. And so I think it's hard to argue otherwise that rates isn't a big part of this.
So are we back where we were before, where, lower rates and then tech just carries the ball again? And that's enough to get us through this, historically seasonally tough period?
Yeah, I don't know that we were ever out of whatever it is that we've been in since March. Let's call it an uptrend.
Was, though, that the uptrend was over, and we were going to have this correction that was, likely going to be a bit steeper than we witnessed at just 5.5%, and that narrative has changed once again. I think.
I'm not sure that the narrative was the uptrend is over. I think what a lot of us were saying, a lot of the people on the halftime show, and speaking for myself, was that just you're entering a seasonally weak period. You'd had a terrific run up, and that some digestion of that was likely to come. And you saw that after the NVIDIA report. I know, obviously, some of the more bearish prognosticators, if you will, were saying the market's inability to rally on what was a pretty good NVIDIA report is a sign of something was wrong. But I think it just played into that narrative put forth prior, which was you had a good rally into the reports, and so some period of digestion was to be expected, and that's what we have.
I'm glad you brought up NVIDIA, as we show it on the screen. New closing high yesterday. It's not at its intraday high, but it's not that far away.
No.
Either. It's like 502 and change is the all-time intraday high for NVIDIA. So as that stock has come back, I mentioned in the open, as Apple has come back, Tesla started running again, then I guess it's no secret why we're able to be where we are today versus where we were just a couple weeks prior.
Yeah, and let me add on top of that, it's not just tech. If we've got the charts, you can throw up Bristol Myers. A bunch of the retailers, everyone was all upset after the retailing report. Take a look at TJX, Ross Store to a less degree, Walmart.
We'll cycle through some of those. Keep going.
I'm going quickly here.
No, keep going. It's all good. Because discretionary, by the way, if you look at the sectors that are actually doing quite well, as I pull up discretionary today just to give you all a look, it's having just a fine session now.
Now, mind you,
it's up more than 2% in a week.
Now, mind you, when you look at discretionary, you have to remember
Tesla is obviously.
That's right. Tesla and Amazon. That's right. But
Amazon too.
Amazon too. But even when you take a step back from those, again, TJX is basically back to a high. Walmart's basically back to a high. I keep mentioning every time I come on a bunch of the industrial names that have to deal with reshoring and electrification, like Eaton, Eddie Tom Nancy. I mean, a couple of these stocks are just absolutely on fire. And that's not to say that the entire market is doing super well, because that's not necessarily the case. But as we power back to record highs, it's not just NVIDIA, it's not just Tesla. A bunch of other names are playing along as well.
You are with the earpiece over there? You're having some repeated problems with that.
I apologize.
We're going to get some glue.
I have ill-formed ears.
We're going to get you some glue.
Okay.
The data, too, has been, a little softer, which is not such a bad thing either for what the Fed wants. And really, I think you could go as far as to say what investors need. You need good data, but you can't have data that suggests we're off to the races again in some sort of, resurgent economic, robustness. If you look at that Atlanta GDP now thing, which was at 5.8%, you're like, wow, this economy's like reaccelerating a lot. You can't have that.
Yeah.
I know, even if that wasn't real,
Yep.
You still can't have a scenario in which the economy continues to get away from the Fed.
No, that's right. And I'm glad you brought that up, because I think I like to think sometimes I come on at narrative turning points, and I think we might be at one now. And I think there's a lot of there's clearly a lot of celebration about the JOLTS report pulling back, particularly because, again, the soft landing narrative put forth by people like Jan at Goldman Sachs was predicated on the bulk of the work being done through JOLTS rather than through, let's say, the unemployment rate. So there's a lot of celebration of that. But at the same time, I call back to a point that I was making a year and a half or even 2 years ago, which is this idea that the Fed cannot fine-tune the economy. And as you decelerate here, It's not like I'm driving in a car on the West Side Highway and I can go from 80 to 60 with some level of precision. As the economy decelerates, the challenge for the Federal Reserve, of course, is to decelerate just the right amount. And are they able to do that or not? Because the answer to that question is largely going to be determinative of what happens for risk assets.
Well, the risk is that they smash it.